episode. My apologies for getting on late here. I was having a bath with the kids and I didn't even realize it was like 7:20. I'm like, oh shoot, I'm 20 minutes late. So here I am. Welcome to the show where hopefully people can get the notification and jump on. Today we'll talk about how to invest in a recession. So what are some of the ways you can invest more prudently? How are we investing differently than we invested before? We are, by pretty much every definition, in a recession. The Nasdaq's more than 30% down year to date. The S&P 500, I think, is a little over 20% down the year. So there is definitely more potential downside. And just kind of keep that in mind as we're looking at crypto down 70, 80% on the year to date, or in the last, from all-time highs. Same looking at, growth stocks and crypto. Real estate from the all-time highs here in Ontario, down about 28%. In some pockets, we're seeing a 30% pullback. Some pockets, 20% pullback from the all-time highs in February or March. So if you bought a house then, at the peak and you paid market value for that house, then today you would have lost, if you put 30% down, your entire 30% down payment is gone. You have zero equity in the house. That's the reality of where we're at now. Could things get worse? The answer is yes, but how much worse? And I think that there's not that much. There's a higher probability of upside than there is of downside. I think that there's a real possibility that in the next 24 months, we revisit, even if it's momentarily, highs that we seen earlier this year. So there's a lot more potential upside, I think, than there is downside, but I think more downside is possible. So being prepared if you're investing with a long time horizon. So if you're going to buy into the S&P 500 right now or the Nasdaq, not a bad idea, right? You're buying into the Nasdaq at a 30+% discount. Not horrible, right? Buying Bitcoin at, potentially 70, 80% off its highs, not terrible. Could it go another 20, 30% down? Yes, depending on what asset you're looking at. Some are, a lot safer asset wise that really can hold their own, as opposed to, we're talking about, assets like cryptocurrencies or growth stocks. They tend to not hold their value as well. So that's something to think about as we invest in these times, is just being very, very careful that we run our numbers. When we're buying property, we're in control. When you're buying that S&P 500, if you have a 10-year time horizon, it'll be fine, right? You'll make lots of money over the long term. You'll make as actually looking at an interesting study this week, they did a meta-analysis on the S&P 500. And if you net out inflation from the 70s and 80s, the S&P 500 is actually cranked out like a 4.5% CAGR, which is compounded annual growth rate. That's pretty shit, actually. That's real return net of inflation. That's what the S&P 500 has actually cranked out net of inflation since late 70s, early 80s. That's wild to me. Like, that's a 40-year time horizon, right? So over the last 40 years, or a little over 40 years, there's been a real growth of 4.5% in the S&P 500. Maybe it's because I have other opportunities at my fingertips, but like, if some flipper calls me and says, "Hey, I'll give you 60% loan to value, and you give me a 12 I'll give 12% or something. And if I default, you take the house, take all my equity, and your return goes from 12% to 25%. That's how I bake my contracts. When I'm lending, if they don't pay, they're going to pay big time, right? Because I have to go after them, legally speaking. And then it's just important to look at the underlying asset that you're securing against and the underlying person as well when you're trying to underwrite these types of deals. To me, it's one of my favorite places to invest right now. So if you are a good operator right now, and you're having trouble raising capital, and you have a great deal, I don't care where it is in the world. Well, I do care where it is. I only want to land in the US and in Canada. But if you're looking at a great deal right now, no matter where you are in the world, but if you're looking at a great deal right now, and it's 30, 40% under current comps, I'm talking about right now, not comps from, comparable sales data from 2 months ago, because that could be dated and it could have fallen significantly from then. If you look at real data, like selling right now, and you look at a few really strong anchorable comps, you can get maybe even adjust down 5 or 10%. You're 30% under that, which is possible in this market, because guess what? There are no offers. Properties are sitting and they're getting no offers. So it's your chance to go in there and really negotiate. Off market, even better, because someone sits on market, they don't sell. You can negotiate off market with them an even greater discount. In a bull market, I could buy properties at 20% discount. In a bear market, I can buy at a 50% discount in many cases. So that's what you need to have in order to make money, right? So that's the business of real estate. That's the beautiful thing about real estate, in my opinion. I just froze my phone. Sorry, guys. Whoa. Sorry about that. I clicked something on my phone and I lost half the screen. We're back. Lost my train of thought. Oh, why real estate is an outperformer, in my opinion. And that's because we can inject our time, right? So we can get in there and we can buy properties at a good enough discount where we can get and use leverage to put 20% down and get a 5-to-1 levered return. You can still buy it and say an 8 cap, and you can still, if you're a really qualified borrower, you can still borrow at 5. We just bought a cottage last week, a beautiful cottage, like has stairs right down to the beach, beautiful Lake Huron near Grand Bend. I love it. I'm super happy about the cottage. We're going there again this weekend. We were there the last weekend. It's a beautiful, beautiful property, a little over a half an acre, back onto a ravine and conservation. I picked it up for $649,000. I think it has the value potential to be over $1 million. So it was a significant enough discount that it made sense. I locked in, I qualified with the bank. And so, by the way, to say it's impossible to still qualify with the banks, not true. There are high net worth programs you can use. There are business programs. I have 2 full years of tax returns now. So I just use my business to qualify. People asked me that a couple streams ago, and I didn't get to the question in time. I wanted to answer all the questions that day, but I don't think I got to it all. One of them was like, hey, Mike, how are you still qualifying when you don't have T4 income? And the answer is there are a lot of programs the banks use where they'll use your previous 2 full years of financial income from your active business. And so my active business has multiple 6 figures, almost 7 figures top line. So I've used that business to qualify. It's not actually as hard as you think. Like even if you're a real estate wholesaler, they'll use that income once you got a 2-year business doing that. So if your hobbies, for me, my hobbies are like looking at properties and negotiating. I love those 2 things. The third thing probably is optimizing and managing a financial portfolio. That's just what I enjoy doing with my time. So I've architected an early retirement, financial independence lifestyle around that, right? And to be honest with you, I like designing places too. It's like a 4th thing that I really like to do. So this cottage is like a way for me to have a creative outlet to design the place and change it in a way that it's most optimized and utilized. And that's for me just like, sometimes growing up, I didn't have a dad at home, but growing up, like I always hear stories about the dad tinkering in the garage or the workshop and out there outside in the yard doing whatever to keep himself busy. This is my thing. Like real estate is that for me, that tinkering aspect. So yeah. I think that my 2 favorite asset classes right now are, if you have a business as well as a third asset class, investing in your business, putting the time into building your business, investing in the marketing of your business, probably the highest return you're going to get if you're like a special operator, right? That's going to give you a competitive edge. The second one I think is lending. I like lending a lot because it doesn't have that variability. In a bull market, you can invest in equities and make 20, 30%, or real estate make 20, 30%. With leverage, you can make 50, 60, 70, 80%. What's really interesting with the lending piece is if you get big enough and do lending professionally as your full active business, you hire someone or hire a few people to analyze and underwrite deals. Let's say you have to be licensed to be able to raise money from people, but in theory, you could borrow money against other assets you have, take that levered capital, or you put it in the stock portfolio, borrow it back, and take that levered capital and lend it out. And you can lend it out at 10, 12%, whatever, safely, like really, really safely. And to make those kinds of returns while the market's dropping and you're getting consistent 12 means you're outperforming the market astronomically. So anyone who did that, who cashed out a lot of their equities earlier this year and pivoted into fixed income, but not like shitty public market fixed income. I'm talking about using your relationships, calling 10, 20, 30 mortgage brokers and saying, hey, do you have a one-off $500,000 deal that needs funded for $1 million house? Like this happens all the time. Rich people in Toronto, they have a nice house in Oakville or whatever. It's $2 million house, and they're a doctor, or they're I don't know, maybe they're like optometrist or something. So they have a really great, career, and they're like, hey, we need $500,000 to expand our business, and we just don't want to go through the bank or whatever. We got a lot of equity in our house. It's short term, and so we're going to pay it back in 6 months. That's the reason they're not going to the bank, because the bank doesn't do short-term lending. So then short-term lending, boom, you could provide that liquidity for them and get a great return. It could be a 15% return for an 8-month or 10-month loan. That's a great return for you. It's great for them. It's very, very low risk, because if they default, well, they have great income and great credit, so they're probably not going to default. But even if they did default, they got a $2 million house that you're secured against. So you just take their house, right? Or you're secured against their business, you can take, right? So that's where's the level of safety. Yes, you have to litigate. I'm going through that right now with someone. I'm actually foreclosing on a property here in London, so I'll be taking that over more likely than not, and then selling that property and recouping all of my costs and damages. Their equity will be lost, unfortunately, in the process. We hope for as little of that as possible. No one wants to screw anyone, but if you're going to go through the process and you're going to just ghost your lender, they're going to take skin, right? So you're going to probably lose your whole down payment. That's where you got to be really careful analyzing and underwriting the deal. This is one example where I didn't analyze the deal deep enough. I was like, yeah, I'll just fund it. It's fine. I should have done deeper. I think they're going to probably lose their whole down payment. I may have trouble. I'll get all my money back. I'll probably even get a return on my money, but I'll struggle to recapture some of those legal fees probably, and the realtor fees to sell it probably won't get captured. Their entire down payment will probably be gone because the market is again dropping. But that's where you want to be really, really careful. Make sure you analyze your numbers. Go 75% loan to value. Be really, conservative and understanding of that value. What else can I tell you? I think there's a way to outperform in that space. If you can go out there and call 20, 30 agents, go network at a real estate event, you'll find that all the real estate investors right now who are flipping, a lot of them are able to find deals at 50 cents on the dollar, but they're fully tapped out on the mortgages they can acquire. They don't have access to capital. And it's a lot. If you're a good operator, it's way cheaper to borrow money than it is to partner up and give away equity. 50% of the equity should be a lot more expensive than a 12% mortgage short term for less than a year. You're giving away way more of your profit. It's actually cheaper to borrow 12% debt and do deals in real estate than it is to give away equity if you're good at what you do. If you're bad at what you do, then do the equity partnership thing, whatever. There's pros and cons to both. Some of the value of the JV equity piece is that sometimes the JV partner can bring cheap debt to the table. They can bring other intangible things as well. Sometimes you can JV in a way where they're helping you with the management and stuff like that too. So I'm not gonna say all JV is bad. JV can be very good. Be very careful with who you JV with, but helping you guys understand why someone credible or quality borrower would want to pay 12%. And I've paid 12% a ton on flip projects and stuff because 10 and 12% is, to be able to have that flexibility to take a deal down and not have to share any of the equity and just be able to move quickly. The amount of time you spend negotiating with your JV partners and writing the agreements and all of that, it's a lot quicker just to borrow the money, done, do the deal, sell the deal, or whatever, refinance the money out and pay them back. You either refinance into a cheaper product or you sell the property. Those are usually the planned exits, and making sure you have those multiple exit streams. All right, some questions here. William, hey, how you doing? That's right, we should talk about that. That is big news. So William says, big news in the States is Hurricane Ian and the gas lines in Europe being sabotaged. Yeah, Florida is a huge state and has a lot of the GDP for the United States, actually a large enough portion that it would have an effect on the whole U.S. economy, at least to an extent. More so, I'm worried about. I have 2 active projects right now in Florida. Luckily, it looks like Hurricane Ian's going to end up being category 1 to 2 by the time it hits one of our properties. So we're going to be okay. My brother's down there. He's battening down the hatches, getting ready for Hurricane Ian to slide through there. The 2 properties we have are inland, like an hour and a little over an hour inland, so it should calm down as it runs through. We're not sure exactly where it's going to hit. At first, it was like Tampa was the worry. It looks like it's going to be a little bit south of that now, maybe come in towards Orlando, which is great for me because I'm north of that. So hopefully just get a bunch of rain, nothing too substantial. But yeah, I feel for the people going through that right now. It's wild. People are evacuating, and it's part of why I don't think I could live in Florida year round or the Bahamas all the time. I could call it residency. I could live in the Bahamas, but I want to escape somewhere like Canada. Canada's beautiful. We have no hurricanes. Like, being in Canada during hurricane season is it's great. What is hurricane season? End of June to like November. It's beautiful in Canada. No snow flies at all till after that. So yeah, I'm glad I'm not in Florida right now. But at the same time, there's something so beautiful about a nice storm. Like, I don't know, I'm enthralled and excited by it. And in another life, I could have been a storm chaser or something. Because as a kid, when like the big storms would roll up off the lake and there'd be like 8-10 foot waves, I'd be running out there trying to play in the waves, and like, I just want to watch as like the lightning cracks across the skyline. Just beautiful. For me, just something peaceful about rain too. I love the sound of rain. If I run a sound machine, I like the sound of rain. Just peaceful, helps me sleep. So for me, it's very peaceful. But I can understand how like loud winds and rain is damaging to property and can kill people. So not cool. And yes, in Europe, the whole out of Russia, the whole line being sabotaged or severed, and the whole energy crisis is causing additional problems with inflation. So today, it seems that the UK has kind of come out and said, hey, and it seems like the whole of Europe will follow, we are going to start quantitative easing, which is crazy. It's like, wait, you're going to start easing? I thought it was tightening. Everyone's talking about tightening right now to get inflation under control. And it's like, let's stimulate people. Let's give people money because utility bills are going to be high. Let's cap the utility bills and just print money. But at the same time, we're raising interest rates. But we're printing money. Oh, wait, but we're going to be doing some quantitative easing and tightening. Easing, tightening. It's like, what? The mixed messages are really confusing. Inflation's still out of control. Yeah, so today was an interesting day. Quantitative easing, though is horrible for the long term, is actually short term really great for a relief rally in the stock market. Everyone's like, yay, give us money. Let's all like celebrate. So the stocks rip, right? Because as soon as you add money into the system, well, it ends up going back into the hands of the investors, right? It ends up increasing the ability to raise capital. It increases, the ability for people to buy things, which ultimately leads to more inflation, which is part of why my initial hypothesis that we get this under control by next year is starting to waver. I think there's now a third option. There was like option one, which is like we crash the economy by like early spring next year, and they're forced to lower rates and stimulate because they've crashed the economy. Or they get inflation under control, in which case, like, again, they've crashed the economy and they start easing again. But now I think there's a third option where they don't get inflation all the way under control. Inflation sits at 5 or 6% because they tighten and then they ease to help people. They tighten and then they ease, and they drag this problem out for 2 or 3 or 4 years. It's a real possibility where we sit in a higher interest rate environment, and it's shitty for business owners, for raising capital, for real estate especially. It makes real estate, for a number of reasons, I think real estate has a bottom, and so I don't think we'll see a crash like we saw in 2008. I think we'll see a period of drop and then a period of flat in this new normal of higher interest rates where $1 million property doesn't cash flow. A $500,000 property has trouble cash flowing at 7% borrowing cost, right? And that's a reality, especially in Canada. We're talking about a 3/4 basis rate hike again in October, and then again in November. Sorry, guys. My throat's killing me. My kids brought something home from school a little cold, so I'm battling that. And my throat's a little raw to begin with. I should have brought some like honey or lemon water down. Okay, let's keep going. Hey, Tristan. Yes, I'm good, thank you. Mike, are you bullish on the UK now that they are starting quantitative easing? No, so I think the QE is going to result in more inflation. And I think that it's going to be a gong show because they're going to be between a rock and a hard place where they try to ease, but then they result in basically having inflation run wild, right? The problem is that if they quantitative ease and other countries don't, like the United States, well, we've already seen this, but the pound is collapsing. The euro is collapsing. That's what happens. If the US is basically the reserve currency. So if the US says, hey, Jerome Powell says, hey, we're going to do another 3/4 basis point hike. And the UK is like, oh, no, we're easing, like we're stimulating. Their currency is going to collapse. They're fucked. And that results in drops in GDP, which results in further pain. They're going to have to do further easing because the currency is collapsing and people are going to be struggling with, when you don't have good exports, it makes the GDP weaker. It makes the currency weaker. As a result, they will eventually have rapid inflation. Inflation's actually worse than anything else. I know quantitative easing sounds great and it can be great, but I think it will result in, and every time you have quantitative easing, it eventually results in quantitative tightening. And so there'll be much more pain ahead for the UK because of too early quantitative easing. And I think it's because they're trying to kick the can. They're trying to deal with, in my opinion, they're trying to deal with this inflation crisis after they deal with the energy crisis. And they're deciding that like we have two hard pills to swallow: an energy crisis where people can't afford to heat their homes and people freeze to death. And if we tackle this issue and put money in people's hands, then they're going to create inflation, right? Or we tackle the inflation issue and we continue quantitative tightening and dropping things down, and people freeze to death, right? So I think which one looks worse? I think they'll probably let inflation run a little wild. That can be a good thing for assets, right? Inflation, remember, over the long term carries assets. And with leverage, assuming the cost of debt is fixed, and by the way, a lot of the mortgages in the United States and in the world are fixed. A lot of these large REITs and stuff have locked in debt swaps at like 1, 2, 3%. So those companies continue to operate in a space where they have fixed debt at 2%. The interest rate rises aren't necessarily directly affecting them to the same extent, right? So there's a number of reasons why I think real estate is sticky, why I think businesses will be okay through this time. I don't know. We're actually at the mercy of idiots. Like legitimately, like the Prime Minister of Canada, as an example. I think he's a drama teacher, right? He has no qualification at all to be the Prime Minister. He's a fairly good actor, I guess, which has served him fairly well to get into politics. But we have idiots who don't understand economics at all and or don't care because they're like trust fund or so wealthy that they're disconnected from what the people need. The problem is there's different segments of people, right? You've got the people at the, like, we'll call them like the wage cucks, like the 70% of people that are on salary. Inflation destroys those people. Like you make 50 grand a year and you have a 10% inflation, you're fucked. You just got a 10% drop in your pay, right? And your rent's probably ripping up, your groceries are ripping up, and you basically have less buying power. There's nothing you can do. You can't go to your boss and be like, hey, pay me 15% more. It's very difficult to do, especially when there's layoffs, which is what is going to happen. There will be layoffs. The jobs data is still strong, but it's a lagging indicator typically of the consequences of what they're currently doing with the quantitative tightening, as well as the raising the interest rates, is going to create a recession. We're already technically in a recession, but a deeper recession, which will be further exacerbated when the next quarters come out and we see there's losses and then people start getting laid off. It creates a snowball effect. With high inflation, it's a shitty time to be in. Like the 80s were horrible as an investor because inflation was running wild. But excuse me. If you're rich or you have a lot of leverage against good quality assets that will appreciate over time, over a 5-year period, inflation will carry your assets to levels that are, 15, 20%. If inflation sits at like 10%, let's say, over 5 years, that's a 50% change in the value of your assets, right? If you're borrowing at, say, 5% fixed, that's a really good opportunity for you to make a great spread between the cost of your debt and the inflation, ripping. So in the long term, inflation will result in some currency devaluation effectively too. Another reason why I like hard assets like real estate. Oh, my throat's killing me. Thinking of buying the British index or British utility energy companies. Tristan, you're not wrong. You can make a small bet on British energy companies. You got to remember the stock market is future looking, right? So when things are their worst, will probably be as we come into this winter and there's an energy crisis. I think that'll be when it's at its worst. That's when you want to buy if you're hypothesizing that things will get better. It really is predicated on what Russia does, on a number of other countries and factors that we have no control over. So it's a lot of gambling. But long term, yeah, if you're buying discounted assets for pennies on the dollar or a significant enough discount, I could see a long term, the UK would come back from this energy crisis for sure. I mean, it's not going to be forever. So yeah, that could be a great investment. Would I put my whole portfolio on it? No. Maybe a little bit. Yeah, it's not a bad idea. I think there's more pain ahead. I don't know that necessarily. Well, one of the challenges is you're probably not going to want to spend your money in the pound or the euro, right? Eventually, you have to convert back to USD or Canadian. And because they are quantitative easing while everyone else is talking about tightening, the value of their currency will be, a number of other reasons are at play, but it will not be good for their currency. So you might win 10% on investing in their indexes, but then lose on their currency value, right? So it's a challenge. There's a lot of thinking you have to go through to think that through, and I haven't spent the time to think it through, but when times are the worst and the bloodiest and fears at the maximum, it's typically not a bad time to invest a little bit. Smash the like button, guys. Boost the algorithm for the free knowledge bombs. Thanks, Will. Appreciate it. Yeah, I mean, it would be great if you hit the like button if you're watching this right now and you're watching the replay. Hit the like button, jump in the comments. All that stuff helps to grow the the user base of the channel, more people will find it. If the YouTube algorithm or the YouTube gods believe that there's value here, they will promote it to other people who are like you or who have similar interests to yourself. So that'd be helpful if you are getting some value to share it. So what is happening in England? Well, I just explained that a second ago. If you just roll back. Parappa says, hey Mike, what variable interest rate mortgages should investors be prepared for? So I just was comparing with the bank when I was doing my cottage, and we ended up doing 5.19 2-year fixed. Not a great rate. That's where we're at right now. The fear is at the maximum. It was at 4 and a bit ago. So that's why I locked in at for a 2-year fixed with an option to renew early if I want to. The variable is at 5. So there was not a huge spread between variable and fixed. My hope is that in 2 years rates come down a bit and the fear is less, or we're at least in a recession by then, so rates should fall. I think we won't see maximum rates until next year. Maybe springtime, end of springtime, we'll start to see the high rates, and then I think it'll be like, okay, it's just crippling the economy, and then we're in a recession, and so they'll start quantitative easing, they'll start lowering rates back down. So that's my hypothesis. I think it'll take another year to drop down to where, where it's reasonable at 3 or 4% again. That's my hypothesis. But it's also like there's a third divergent reality potential where it's just like the 80s. And we sit for 8 years at like 10% interest and nothing fucking works. And it was a hard time. Like Dave Ramsey went bankrupt in real estate for a reason, right? He was, well, not a good operator, that's why. But yeah, debt can be scary. If you're securing expensive debt against assets that are not performing well and don't have good cash flow to service the debt, and by the way, in any major metropolitan, Toronto, Vancouver, LA, New York, pick any major metropolitan, you buy a property there or in surrounding area, I guarantee you right now the cap rate is less than 5 or 6. You're borrowing right now at 6 or 7. So you're losing. Anyone buying property in any major metropolitan right now using debt is losing. They're gambling on the fact that interest rates are supposed to come down. Hopefully they do, but they might not. So we might be in a flat economy for many years now. Who knows what can happen? Depends how shitty the government handles this situation. There could be a battle back and forth with inflation for years. Hopefully they'll Volcrest. Did in the 80s. My throat's killing me. I'm gonna wrap this up early, guys. I'm sorry. I'll go quick, rapid fire. Any tips on how to prepare to survive the recession and also take advantage of opportunities? So first things first, never deploy all your cash in a recession. Until you see things are improving, even then it could be a bear market rally. So you gotta be very, very careful not to deploy all of your cash reserves. Cash is king in a recession. You need to have liquidity. So that's the number one. Is like, even if you have lines of credits that you don't touch, keep them there. You need access to that capital. Super important to have access to it. Next, cash flow assets, also important in times of recession, because again, cash is king. So you want to have assets that produce great cash flow. You don't want to be doing a ton of risky flips or taking on, risky crypto type asset classes as the majority of your portfolio. That said, though, in a recession, if you get lucky enough to time anywhere near the bottom, even 10% within the bottom, and you can hold those, say, buy Bitcoin at, say, 10,000. Maybe Bitcoin goes to 5,000, who knows? At 10,000, you buy Bitcoin over a 5 or 10 year horizon. If you don't need that money, if you just have that money locked away and not think about it, not look at it, you can make millions. This is the time where people are millionaires, and where millionaires become decamillionaires, and where decamillionaires become 8-figure entrepreneurs, right? This is an opportunity I'm really excited about, where you can really build a business and really build a portfolio. So I'm excited about, yes, my net worth has dropped, same as everyone else's. Like, my net worth has been affected by about the S&P 500. Mostly, and I wouldn't have been because I shorted the market. The thing that's dragged my net worth down this year was the crypto miners. That was a horrible investment. I had a big crypto mining operation, which they're basically obsolete now because I was mining with GPUs. So I have a whole bunch of those I have to just basically get rid of for pennies on the dollar. That was a horrible investment that I made earlier this year. And then also crypto. Like, I invested in cryptocurrencies like Bitcoin and Ethereum and a number of others, and that really did not do so well. So those are the majority of my bad investments for this year. I had a lot of great investments too this year. Like, I've been shorting the market. So my active portfolio is outperforming both the Nasdaq and the S&P 500. My dividend portfolio also outperforming. I think I'm only down like 5% year to date, and in the last year I'm up like 10%. So that's great in a recession that those portfolios are doing well. My real estate stuff, like I stopped buying last September, but all those properties that I was buying before that, I'm now disposing of with huge profits. And I've now just bought, I just picked up 7 properties. Just started, like right now I started buying. So I'll probably buy 20 properties in the next, well, including what I've already bought, in the next 6 to 8 months. I'll be taking on 20 new projects. That's how I feel about the real estate market right now. I'm dipping my toes in. I continue to buy. I'm building, right? Because I think there's going to be a point of, it may go further down, but there will be a bottom and it'll be flat for some time. We will have a roar again. And I want to have a quality asset portfolio when that time comes. So yeah, I mean, talking about what I'm doing, lending too. I'm doing a lot of lending right now. I take my I take my stock portfolio, I borrow back from it, and then I do a lot of lending. So that's been what I've been doing with my capital. I do some borrowing too. On some of my flip projects and some of my more active business stuff, it makes sense to use other people's money because I can deduct that interest. So if I pay, 10% interest, half it's deductible. So I really am paying like 5. So it's not a huge cost really when I can buy assets that can return me 20, 30, 40% over a 6-month period. So I can churn assets and make great returns using, fixed, relatively expensive debt, but less expensive than it was relative to prime. Just be careful these times, guys. Like, you gotta be really, really sure of your numbers. That's one of the things this investment economy is, being very, very sure of your numbers. And if you have a time horizon that's short, making sure that you have that liquidity, making sure you're not in a position where you have to sell at the bottom. You don't want to sell at the bottom. So that answers that question about what I'm personally doing. Next question was, is there any money to be made buying a condemned house, tearing it down, and having a new one built? I think no. I've never seen a development opportunity like that has made sense for the effort and time. The reason is the city will take you forever to go through. You'll be fighting with engineers, with the city to build. I find the restrictions drag these projects out for 12 to 18 months. It takes too long to get that done. And building costs right now are through the roof. So it's really expensive to build, hard to find quality tradespeople to do things at a reasonable price. So your costs are really high and the timeline's really long. So you're pouring money into the project, trying to carry it. There's just not a lot of margin. I'd rather just do a cosmetic flip, boom, done, and not involve the city at all, right? Like paint floors, kitchen cabinets, vanities in the bathroom, done. Change out some toilets, landscaping, put a new roof on, done, right? Like all that requires no permit in Ontario. So that's like a project that I love, as opposed to something that's like structural and you're fighting for years with the city. No. I tore a roof off a house and put a 2nd-story addition on basically rebuilt this house, and I've been fighting the city for almost 2 years now with engineers involved and all. It's a bitch. I could have flipped 10 properties in the time it took me to do that one long project. So it's fun to try. I get it. Like, it seems attractive. The returns aren't there because it takes so long to do. I'll still make great money on that project, don't get me wrong. It's triple what I paid for it, but yeah, it's not, just not, I don't think it's the most fruitful use of your capital. Though some people, that's all they do, and they have a business carved out around that. And so to each their own. I just find the returns aren't as high as they could be in other areas. Talk about the Metaverse real estate. I don't invest in the Metaverse real estate asset class at all right now. I think it's an interesting space, and I think that the future is in the Metaverse. I do have some shares in Meta. I do have a few NFT projects that I invested in earlier this year that have gone to shit. But I don't know. I think that if you pick the right projects, there is for sure value. I think the future is in gaming online and in a metaverse. I think that's a reality as technology gets better and the virtual reality systems are, it'd be a great place to go. People just go after work, they'll go on to like, an online portal where there'll be a pub that's virtual. And I think that is the future for sure. Trying to pick out who's going to slay the metaverse and which, operators are going to be the dominant force in there, or really, like, we don't even know if the metaverse that exists now is the metaverse of the future. Like, you might buy real estate in a metaverse that no one ever goes inside of. And Facebook might come out with their own different metaverse that has real estate in it, in which case your real estate's worth nothing, right? So because it's Fugazi, you have to be very, very careful. I would prefer to invest when I see there's mainstream adoption. It's the same reason I waited to invest in cryptocurrency. I didn't know that Bitcoin in 2014, I had people being like, Mike, buy some Bitcoin for a couple of bucks. And like at the time, there was not large user adoption. There wasn't a large node network. Didn't have strength behind it. It was a penny stock. And I don't touch penny stocks. It's not me. I don't get those 100 baggers, unfortunately, because I don't take that kind of risk. But yeah, I think that there's a very high probability that we will have a metaverse, and that it will, it will definitely be a place that I'll be wanting to invest. And I don't really understand how the real estate in the metaverse is going to generate rent. I get that people can rent it, but you need somewhere to live. Like you're going to freeze to death in Canada if you don't have a house in the winter. You need a place to even you need a room just to like set up your VR stuff and chill in the VR world, right? You need real estate in the physical space. You don't necessarily need real estate in the virtual world because there will be a ton of free real estate you can go and access, right? And you just log out and log into a cafe. Like it's not real. So the real estate, I don't see the pressing need in the same way that I see a need for housing. It's more of a luxury. It's like luxury real estate. So I don't know. I'm still neutral on the metaverse real estate. It's not a place that I'm investing any capital right now. In the future, I may. I just can't see the cash flow behind it. And with real estate, I got to see the cash flow. I don't know. It's got to be cash flow positive from day one. And I don't know that I could rent out my real estate space and in the same way. It wouldn't have the same allure to me because cash flow is king. I'm less of a speculator and more of a, I like to invest in tried and true cash flow businesses. Hey, how you doing, Eric? So Prepa says, so should we be ready for variable rates up 6% or stress test for higher? Yes, I think that's a very real possibility. Next month, that's coming. I also think it's a very, very real possibility that in Canada, we go back to 35 and 40-year amortization mortgages. We're currently at 25 is the maximum. I think they're going to expand things to make it more affordable for people. They know that the rates are going to be short-term, really high, but will long-term come back down. It goes in cycles. And so I think that them doing that will, it'd be the Fed basically adding a little boost to the real estate market. So I think that's a real possibility. The 35 and 40-year amortization mortgages are coming back. That will bring down payments significantly. Yeah. But yes, you should definitely be stress testing those variable rates at that rate. ERP says, are you still moving to Florida? No. I still snowboard in Florida, yes. I currently am still calling Canada home for a number of emotional reasons. It makes zero financial sense. Like if I didn't have 3 kids and family here and all the things that the active business and like I have a strong network here. So doing business in Canada gives me a huge competitive edge that I don't have in Florida. I'm still building that. I'm working on trying to develop that. But in Canada, I literally have like 10 plumbers in my phone. I have 10 electricians. I have 20 of everything. And my network is strong and robust. As well as emotional reasons, it's really easy for me to continue doing business in Canada. That's why I can pick up flips like nothing and turn them around. It's more difficult in Florida, and I'm building that out. Florida doesn't have a great tax system compared to Canada. It's a little bit better. But the federal tax rate's like 35%. And in Canada, I can run a business here and pay like 15% on the first $500,000 in net income. So if I have $1 million, I have $500,000 in expenses I come up with throughout the year, then I have $500,000 net, paying like under 15% tax. So Canada's not that bad. I understand that if I made Bahamas my primary residence 91 days a year minimum, which means I can spend 275 days outside of the Bahamas, split between, say, Canada and the United States, with neither of those countries getting me for more than 5.5 months a year, because I don't want them to consider me a resident. I don't want to be a resident in Florida. I don't want to be a resident in Canada. I want to be a resident in Bahamas, and then travel for 9 months a year between Canada and the US, right? That would be kind of like an ideal tax haven, because in the Bahamas, you file no tax return at all. Nothing. You report nothing. You buy Bitcoin and become a billionaire, they don't care. No reporting, nothing. That's really cool to me, is that there's no reporting, because tax time's a pain in the ass. Just not having to report is huge. Saves you dozens and dozens of hours. Now, as well, I think that there are a number of reasons why the lifestyle is better that way too. I've just not, there's emotional reasons why I haven't left Canada yet. Hey Mike, bank is asking to make lump sum back or increase monthly payments and other options to keep paying what I'm paying and deal with overages in 4 years. What have you been doing for variable rate mortgages? So it depends on the type of variable rate mortgage. Some variable rate mortgages are fixed amounts, in which case your payment is fixed until the rates get so high that your payment has to reset. So until basically the entire, let's say your mortgage payment was $3,000 a month and it was $1,500 interest, $1,500 principal originally. As the rates go up, the interest payment portion of that mortgage is going to become the whole $3,000. You have no principal pay down on your payment. If it gets over $3,000, it will trip and it will reset the payments. There are other options, other types of products where you can pay extra. I personally would just not pay down principal. I would keep the cash in my hands. I don't want to pay down. For me, I just don't want to pay the bank back. I want to keep the bank's money. I want to keep using it. I know that in my hands, I can do a lot more with that money. Say I'm paying 5% or 6% for that money. I can do a lot more with 6%. I think my average debt is around 5% right now. So with that 5% money, I can make 2 to 3 times on the cost of that money. So why wouldn't I take those dollars? We might have another conversation at 10 or 12%, right? At a certain point, it does make sense to pay down expensive debt, but we're not there yet. And so I think having cash available is more valuable than paying down the debt. So I still would not pay down your mortgage. If you can avoid it, awesome. Keep cash reserves instead. So as rates continue to rise, you have those cash reserves there. Yeah, if you have a HELOC or something, that'd be great. Put it on the HELOC, save the interest there. And if you need the money, you can just take it off your HELOC. HELOC is home equity line of credit. Cool. Through all the questions, my throat is burning, so that is great. Cost segregation. So in Canada, what you can do on a property is you can take, say a property is worth $100,000, you can take $750,000 or like 75 or 80% of the property and say, hey, this is building. The other 20% is land. The part of this building you can depreciate each year. You get a deduction for that. If you go and sell that property down the road, then you have to recapture all of that capital cost allowance. Is my understanding. So you basically depreciate. Same with renovation, capital expenditures. You put a roof on, you can depreciate it over a number of years. Again, I'm not an accountant, I'm not an expert in this, but yes, there are definitely ways that you can use real estate to pay no income on your active income. You can make 100 grand a year in Canada, buy a couple of rental properties. In the first couple of years, you're fixing the properties up, you're investing in the property, you're increasing the value of it, and getting all those deductions to bring your income to zero. You make 100 grand, you have 100,000 deductions from the rental properties portfolio that's at a loss in the beginning because you're building equity in the property. You can refinance that equity out, pay no tax, be all cashed up because you bought a property for 200, refinanced it at 400, pulled that money out. But to the tax man, they don't care about the refi. All they see is all these renovation deductions you can use to offset your day job income. So in reality, you can use real estate to effectively work a $100,000 a year job, pay no tax here in Canada. It's the same in the US, but yeah, real estate is a beautiful tax strategy. I think everyone should have rental properties in their portfolio. It is a pain to be a landlord. There are ways to make it easier by bringing on good property managers. I have an amazing property manager right now. She's awesome. Hit me up if you're ever interested in that. I have a couple properties in London that are coming up for sale that we're finished turning around. I have a triplex downtown if anyone's interested in that. I would be potentially open. I don't know if my mortgage is assumable or not, but I have a really good mortgage on it. I don't know if it would be assumable or not, but anyway, I maybe be open to something with that. I could keep the property. The only reason I would sell it is because I can take that money out of that property and I can do a lot more with it. I could continue to flip and I could get more return on investment, but I could also keep that property. I have another property with a tiny house in the back and a main house. It's basically a triplex. Hit me up if you're interested in that one. That one I don't have a good mortgage on. I need to sell that one. It's got an open mortgage on it. Yeah, that's my situation right now and as far as for sale properties. Thanks everyone. I'm gonna wrap it up. My throat is burning, so I'm gonna wrap this stream up. There you go. So you're right. There are some situations where that's true. Totally true. If you were to buy poorly. Most people in this market have made a ton of money in real estate, so they have to recapture. My name is TY Mike. Have a good week. Thank you, William. All right, everyone. Thank you so much for watching. Appreciate you tuning in the live stream. We will see you next week. You know where to find me. At Mike Rosehart on Instagram, Mike Rosehart on Facebook, the blue check mark on Facebook, and rosehartcapital@gmail.com are the places to get a hold of me. The secret to unlocking a wealth through you is to spend less, earn more, and maximize returns in the difference. Those are the 3 levers. You're in control of your financial future. Any of us in the next 5 years have the potential to become financially independent. We're going into one of the best times to really start saving. The most important thing you can do is save right now and invest. Thanks, everyone. See you next week.